just by definition, tax advantaged account, whether the Roth or traditional, are going to be better than the taxable, because the taxable, again, are going to be taxed at all three levels, whereas a Roth or a traditional are only taxed at one. But do you want to pay more upfront, or do you want to pay more on the back end? That's kind of what it comes down to. And the answer is, if your tax rates are the same, it really doesn't matter. A traditional equals a Roth. So just for some nice round, easy numbers, if you invest $10,000 for 20 years with a 7% return, and you pay 25% tax, let's see what happens. So with the Roth, because you have to pay 25% tax up front, you really only have $7,500 to invest. You don't have $10,000. And with this 7% rate, you're going to expect your money to double about once every decade. And you see that it comes out to $29,023, and that's all your money. So that looks pretty good. With a traditional, you get to invest the full $10,000 because you don't pay any tax. Again, you would expect that money to almost double twice, and you see that it's $38,698. So you have substantially more money on paper in a traditional account, but you owe tax on that. So some of that money is going to Uncle Sam. And the part that's yours, if the tax rates again are the same at 25%, is $29,023. So it's exactly the same. And so the main take home that I was trying to get when I originally made this slide is that sometimes you'll hear people say that Roth are superior to traditional. And that's just not the case. And sometimes you'll hear, and this is particularly from tax preparers who really focus on the current year and aren't looking at the long term, they're going to tell you tax deferral is better because you're going to save money on tax. Well, you're just pushing it off. You're not really saving necessarily. And so traditional is not always better either. It really comes down to when you pay more. There's a couple of other things before we move on, because that's a lot of what we're going to talk about the rest of the presentation. But before we do, we want to also think about a few other things. One is, what if you had substantially more to invest? Because these accounts have contribution limits. So let's say you wanted to try to max out your Roth 401k for the year. Well, the maximum in 2025 is $23,500. But if you're paying at this 25% rate, you would also have to pay $5,875 in tax. And so you'd need almost $30,000 to be able to max out your Roth. Now, if you maxed out your traditional 401k, it would take you only $23,500 because you wouldn't pay income tax. And now that $5,875 you have that you've saved on taxes this year, there's nothing saying that you can't turn around and put that into a Roth. And so now you have the $23,500 in the tax deferred money that's still at play that you may be able to pay less on later. We don't know. But you've also have some money in a Roth. So it's not an all or nothing decision. So you can use this, if you're disciplined, to save money on your taxes and then invest in other areas. And having some tax diversification is a nice thing to have in retirement. And we'll talk a little bit about why.